Well, investing in equity markets is all about the betting on the right horses. Now, what has worked all this while may not necessarily work in the future. It may not. I think if you read the brokerage notes that have come out this morning, everybody's talking about a major shift in portfolios. So, there is a shift towards defensives. People are suddenly assuming that the new government's policies could be tilted a bit towards welfare schemes or populism, and therefore or rural consumption, and therefore watch out for FMCG, and the stocks have reacted. So people are moving towards FMCG, IT, global commodities, and moving out of defense, railways and PSU linked themes or Capex driven themes. Now, is that a wise decision? If you have stocks which are backed by Capex or defense, should you really shift out of them? Because Prime Minister Modi in his speech yesterday spoke about how the focus will be on making defense or India Atmanirbhar on defense. So it's a chicken and an egg. What I can tell you definitely is that if there was a one-way ride in some of these names, and if your portfolio is tilted heavily towards these stocks, you might want to make some changes, especially in stocks which are expensive. So some of the Capex driven stocks, the MNC names, etc., were trading at maybe 80, 90 times. Maybe you don't want to pay such a top dollar to some of them. Granted, they have a moat and they might do well, but if the Capex focus, I'm not saying it will, but if the Capex focus comes off a little bit, then some of those stocks might see a bit of a valuation derating. So in order to play safe, maybe try and get out of some of those expensive names, get into some of the defensives and make your portfolio a bit balanced. The other thing to do is look at the composition of the portfolio. If 50, 60, 70% of your portfolio is parked in Capex, defense, railways kind of stocks, maybe just change that composition a little bit, go into some of the other sectors as well, which might have a better valuation framework to themselves, and try and balance it out that way too. Either ways, a little bit of rebalancing, not because of any concern around policy continuity. I think there seems to be an unequivocal decision or a belief that there is an NDA 3 in the making, and some of those policies might continue. You just want to play safe for your portfolio construct and rebalance it if it is very skewed in favor of one or two or three sectors, especially the ones which are heavily priced in the valuation front, and move to some of the others which could probably be seeing earnings growth in the next 3 to 6 to 12 odd months. So look at chemicals, look at IT, maybe look at private banks which are not expensive currently. That might actually do the trick and be the best portfolio reconstruction that you can do in the current times.